Good day, Toby Lab from the Accounting Club, where we enable you and your business to succeed. Always good to come on these videos and talk about things to help you and your business to succeed. Today, I would like to talk about things to consider for your financial year end as a limited company. So this video is more suitable suitable for the relevance is to limited companies. So if you are a limited company director, then you want to continue on and listen to this to the content in this video. And so I'm going to be focusing on year-end consideration. So what are the things to consider as you approach your financial year end? So as a limited company, you need to report, you need to prepare your accounts at the end of your trading, and your financial year is your financial year is a trading period of 12 months. So as an example, if your year end is January to December, your year end is going to be December. So what are the things you need to consider as you're getting close to your financial year end? Those are the things I will talk about in this video. So very quickly, we will go through corporation tax overview, tax planning opportunities, dividend management, and then director's loan account. All right, so on the corporation tax overview, the main rate of corporation tax is 25%. So where your profits exceed 50K, you will pay corporation tax at 25%. Where your profits are below 50K, you pay corporation tax at 19%. Now, where your profit is below is above 50K but below 250K, there is an additional margin calculation applicable that will reduce your rate slightly, but that's where your profits are below £250,000. So it is important to know the what expenses you can claim, to maximize your taxes to reduce your company's tax liability as much as possible. So really anything that you have to incur for the purpose of your business, any expense that you have to spend for the purpose of your business, and the term that HMRC uses is only and exclusively for the purpose of your trade. If you are paying for a telephone, is that for the business? If you're paying for uniform, is that for the business? If you're paying for a laptop, is that for the business? As long as it is for the business, it is an expense that you can claim, right? And depending on your type of business, you may have different sort of expenses. Of course, if you're a service business, your level of expenses may not be the same as the expenses of a business that is into products or goods. They have goods they sell, so their expenses, their expense structure will be different to that of a service business. So it is important to be aware of tax legislation. So moving on, let's talk about how to optimize deductions and allowances, which is the tax planning opportunities that we want to quickly talk about here. All right, so as a limited company, you could consider putting money into a pension, and that is up to £60,000 per year, per tax year. The tax year runs from April to March every year, but your company's financial year can be different. So just say per year, and this is individual. Okay, so if you have 3 directors, you can contribute 60K each, 60K for each director into a pension, and that will reduce your taxable profits. If you give to charity, you can consider making donations to UK registered charities will reduce your taxable profit. There is no cap as long as the donation does not lead into a trading loss. So let's say your profit before tax is 50K, profit before tax. You can donate up to 50K to bring your tax down to 0. If you donate 40K, that means you are taxed on 10K. If you donate 60K, if your taxable profit is 50K and you donate 60K, then 50K will be used to write your profits down to 0, and the 10K, additional 10K, nothing. That cannot be carried forward because you cannot use charitable donations to create trading losses. As a company, as you're approaching your financial year end, you might want to consider increasing your spend on capital expenditure. Is it time to renew your company vehicle fleet? Is it time to spend on new machinery, new equipment? You can claim the full cost of expenditure on this on capital spend as a tax deductible expense. Stock. If you're a product business, or you're in goods and you deal with stock, we need to ascertain the level of your stock at the financial year end. And so if you happen to have lost, damaged, or obsolete stock, the value of those can be written off to reduce your taxable profit. Right, so when your accounts are being done, prepared as limited company, these are prepared based on expected money in and expected money spent out, not based on money in, money out. All right, so I have examples of companies who want to spend as much as possible before the year end, as in money fiscally leaving the bank account. That is fine, as it does help with bookkeeping, and it reduces the amount of things to remember if you do that. However, as an example, let's say you need to buy furniture. Okay, let's say your year end is December and you need to buy furniture. If you have a contract to buy that furniture in December, that is fine. Make sure you log that invoice into your bookkeeping records or provide it to your accountant, and then they can make a deduction, and then you can pay for that after December. All right. So as long as you have the contract, you have committed yourself to that expenditure, we can claim that as a tax deductible expense. All right. So you necessarily do not need to have spent the money before we can make a claim, as long as you have an invoice. And similarly on your income, your turnover, it is based on your expected turnover, not your actual turnover. So as an example now on income, if I have a piece of work that I started in December, but I didn't invoice for that, I'm not going to send invoice in January, February, March. I need to include the value of that work in December because I started the work in December. So the value of work that I started in December, I need to include it on the accounts, even though I'm going to invoice for that later. One planning strategy here is to actually delay the start of the work. Okay, so you can delay starting that work or that service till after the financial year end, so that the invoice and the income will go into the next financial year, and you are therefore reducing the income that is subject to tax in the current financial year. All right, so just as an example now, as an accountant, right? If you come to me in December to say that I need to help you to do your tax return, if I start doing that tax return in December, then I need to bill you and I need to include that income in the December account. If, however, I start that work in January the following month or in February the following month, I don't need to include that invoice or the expected payment in the accounts for December. Okay, I hope I've been able to explain that. Next planning opportunity is bad debt. So if you have a lot of receivables that's been over a year and you feel that you will not be able to recover this, then those can be written off to reduce the amount of income that will be subject to tax. And that's what we call deferred income. Bad debt. Okay, deferred income. I think of deferred income. So if you sell software, as an example, software subscriptions are usually based over maybe a 12-month period or 24-month period. So as an example, if in December 2024 you sold software package to cover 12 months, January 2025 to December 2025, and that was paid to you in December 2024, the value of that contract can be excluded from your income that is taxable in 2024 because the contract is actually 2025, but you are paid in December 2024. And that's what we call deferred income. All right. So that income can be deferred to reduce the amount of income that is subject to corporation tax in the current year. Unpaid supplier invoices. This is what I spoke about in under income and expenditure, where you have invoices, supplier invoices that you have not paid, or something similar. Where you have supplier invoices that you have not paid, okay, you need to record those invoices into your bookkeeping system or provide them to your accountant. And this is where a bookkeeping software or system is highly recommended and important to making sure you are able to claim as much tax as possible. Sorry, to reduce your tax liability as much as possible. So if you have unpaid invoices, make sure you record this into your bookkeeping or provide it to your accountant or bookkeeper. And then if you have committed expenditure with signed contracts, but you haven't made the payment, those can be included in the computation. So as the example I gave, what was the example again? If you need to purchase, okay, let's just give you the example. If you need to buy furniture, right, and you have a signed contract, but you haven't paid, you have a signed contract in December 2024, but the payments are going to happen in January or February, then we can include that in the accounts to reduce the tax that will be payable. All right. So those are tax planning opportunities. Now investments, money that you put into the business, those are not income. So the other day I was asking a director, give me your estimated turnover for the next 12 months. And they were giving me a summary of all the money they think, or of the last 12 months, sorry. And they were providing me with all the money that has been paid into the bank account, including money from their own personal self to fund the business. All right. So I had to clarify that no, I need your trading income from customers. So from a tax point of view, it is only income from your customers that is taxable. All right. So investment income into the business, loans to the business, those are not taxable. All right, so those are tax planning opportunities to consider as you approach your year end. Also, as you're approaching your year end, you need to consider dividend. All right. Dividend, you need to have proper documentation in place. You need to have board minutes, dividend vouchers, and ensure that these are processed in accordance with HMRC legislations. Just a point to note that dividends are not tax deductible expense. Let me say that again. Dividends are not business expenses. Okay, so you cannot use dividends to reduce your taxable profit for the company. Dividends are a distribution from your taxable profits, from your profits after tax, and you pay tax on dividends through your self-assessment tax return. All right. So the best practice is to make sure you maintain compliance with HMRC requirements, and you can view our guide on how to pay and process dividends by going to that address to download our guide. So it is important to get this right. One other consideration is director's loan account. Okay, so as a limited company director, there is always the um, use of director's loan. This is where you have taken money that is not salary, expenses, or dividends. You need to keep track of withdrawals that exceed the funds that you have put in. So let's say as a director, you've put in £20,000 into the business. Then you can take out £20,000 tax-free. If you take out £40,000, that means you're overdrawn by £20,000, and there are tax implications for overdrawn balances. All right. So overdrawn directors' loan accounts can incur a 33.75% corporation tax charge. All right. So planning and management is vital on directors' loan. All right. So how can you reduce your director's loan account? You can reduce your director's loan balance by paying dividends, declaring additional salary, payroll bonuses, or paying back some of the loans. It is important to maintain your DLA within HMRC stipulated guidance. Otherwise, you could face massive penalties, and that could affect your financial health. I have a more detailed guide on director's loan, which is which will be available on our YouTube channel. So do feel free to go on our YouTube channel to view all of our other videos. So in a nutshell, this is a compilation of tax planning opportunities for your limited company. We've covered corporation tax overview, tax planning opportunities, dividend management, and the director's loan account. I hope you have found this useful. Once again, Tobilab from the Accounting Club, where we enable you and your business to succeed.